We're here today with Darwin Abrahamson. He's the CEO and founder of Invest and Retire LLC. Thank you so much for joining us today.
You're welcome, Maribel. I'm glad to be here today.
Great. Well, what we want to talk about today are really the important changes happening that will really impact investors' ability to retire, particularly with their 401k plans and other types of plans of that nature. And over last year, I think the Department of Labor saw some changes that hopefully you can bring us up to speed on to help explain to investors how those changes will impact how they will retire.
Yes, Maribel. In fact, the Department of Labor actually caught all of us by surprise with a surprise announcement with these new regulations for participant disclosure, which we've never had before. And the participant disclosures takes place as of November 30th, 2011. And what this is going to do is for every participant that's in a 401k plan, on their quarterly statement that they receive, they're going to have be notified of all of the fees that are coming out of their investment options or coming out of their account to pay for services for the 401k plan. And not only are they going to see the amount of fees that are coming out, but the DOL is also saying that they have to be able to relate it to a dollar amount per each $1,000. So like if you are in a 401k plan, you may see that $250 is coming out of every $1,000 that you have invested to pay for services that you didn't know you were paying for before.
What does that mean? When they open their statement, what are they looking at?
Up till now, what each of the participants have been seeing in their statement, and this is the main thing most participants look at, is their quarterly statement, because they want to see if their account has gone up in value or if it's gone down in value. And that's all they've been seeing up till now. So now they're going to be actually seeing all of the fees that they've been paying themselves that maybe came directly out of their account, or more so it's going to be the fees that have been paid from the mutual funds that they're invested in to pay for other services for the 401k plan.
What's been eye-opening for you as you've looked at this?
The thing that's most eye-opening for me is that we're going to finally get the word out there to the participants to be able so they can understand that their 401k plan is not free. And because they've never seen fees before, most participants actually feel that it's free. As an example, I had one of my Toastmasters members that I went to lunch with one day, and I decided to show him what he was paying in fees with his 401k plan. And he looked down at the statement and said, "Darwin, I never realized I was paying anything at all."
Is there any way that investors can actually keep their fees low?
The individual participant in a plan has no choice because it's their employer that is picking their provider and also picking the funds that are in their plan. But the participants should take a look at these statements, or they should, even before the statements come out next December, ask their employer about the fees that are coming out of their mutual fund options and being paid for other services. And if their fees are too high, complain to their employer and say that there are providers out there that the fees can be lower. As an example, we have actually seen fees that have gone as high as 3% in a 401k plan. And there are providers out there that use investment options that are either low-cost mutual funds or ETFs like we do that can reduce the cost to less than 1%. And
Wow.
This makes a significant difference in the future of the retirement savings.
Darwin, let me ask you a question. What categorize for us the sort of sets of fees that people are subject to? I know that there are fees for the investment in mutual funds, because the mutual funds have fees. There are a group of those fees. It's not just one fee. There are fees for trading. There are fees for custody. There are fees for record keeping. There are fees for investment advice. Help us know how to think about that as an investor.
Well, as an investor and a participant in a plan, the first thing you need to look at is what share class you're in, because there's multiple share classes out there. Years ago, there was one share class. But now there are actually a lot of the mutual fund companies that have created special share classes just for 401k plans that have higher fees. And this will be in the form of 12B1 fees, that can either be paid to the broker that is, or advisor that's servicing the account, or the 12B1 fees may be paid to the record keeper.
When you use a word like 12B1, what does that refer to? I mean, why is something called just a number?
That is a code section under the Investment Company Act
Okay.
that says that a broker that is licensed can be paid an annual fee based upon the assets inside that mutual fund.
And what's the range of those fees?
They will range from 0.25% on the low side clear up to 1.25%.
And are there mutual funds that don't charge these 12B1 fees?
Yes, there are. There are many funds out there that have zero 12B1 fees.
Mm-hmm.
And then there's also what we call revenue sharing fees, or you may hear it as sub-TA fees in the business.
Darwin, talk to us a little bit about the categories of fees that are involved in retirement plans.
Retirement plans have special share classes just for retirement plans that have higher fees than what individual investors invest in. Most individual investors invest in what we call Class A shares, but the mutual fund companies have Class R shares, which are designed for participant-directed plans, and these have higher fees. And the higher fees are in the form of 12B1 fees. Now, the 12B1 fees are the fees that are paid to the brokers that service the plans, or the advisors, as most of the time we hear the advisor for your 401k plan. Now, these fees can vary from 0.25% all the way up to 1.25%. So this is very, very important that you understand what you are paying with the funds that you have in your 401k plan.
So there's a difference between what you pay out of your investment dollars and what the company, the employer pays, and there's a balance, a shifting balance of who's paying for what that probably varies from company to company?
Yes, it does, Al. Varies a great deal. We see many a plan out there where 100% of the fees are actually paid out of the investment options.
Coming from the money that's owned by the individual participant.
That's correct. And then on the low side, you may see down to about 50% of the fees will be paid out of the investment options. So it can vary from 100% to 50%.
What does that mean over time? Let's just say you have a ratio of fees coming out of the holdings that you own in that retirement plan. Those are investment fees, fees coming out of the investment itself. What other fees are involved?
Well, the fees are really important that are coming out of your investment options because the fees directly lower your returns. And if we can reduce your returns just by 1% a year, this can make a difference over 20, 25, or 30 years, anywhere from about $300,000 to $400,000 in the future value of your portfolio.
Say that again. That's incredible.
Yeah.
Yes. I said just a 1% reduction in the fees will, over 20, 25, or 30 years, will increase the amount of money that you're going to have over that period of time from $300,000 up to $400,000 in increased value in your retirement savings.
That's a huge takeaway for investors to actually sit down and look at what's in their portfolio and have a conversation with their plan just based on this.
It is huge, and this is why it is so important that we lower the fees. But this is one of the main reasons, Maribel, that the DOL stated that they were coming out with fee disclosure, because they're estimating that this is going to save the average employee, once they can get their fees reduced by complaining to their employer to go to lower cost investment options, approximately $15 billion a year.
Wow.
Yes, that is huge.
That's huge. I mean, I think when you and I were talking earlier about the average account balance for somebody retiring was something about in the neighborhood of $190,000. Imagine if they had reduced their fees, what that would mean during that retirement age if they were to withdraw funds. I mean, that's huge.
That is huge. That can make the difference between an individual being able to retire at age 65 or not retire at age 65. Mm-hmm. And this is what I believe the government has finally realized, that if we don't change what's taking place with these participant-directed 401k plans, we're headed for a welfare state. And the government realizes that they're not going to be able to support all of these Americans that do not have enough money to retire.
You mentioned the phrase retire at 65. Is that really an option for most people? Aren't we seeing people living to into their 80s and having to keep working?
That's correct, Al. Most people now are living 80s to the 90s. And that's what the huge difference is as well. Because back when Social Security was started, the average life expectancy was 67. So we lived 2 years past the time that we retired. Now we're living 30, 35 years. So we're going to have to save a lot more money than our parents and our grandparents did, because our life expectancy is much longer.
So it's very important for someone in the workforce to start saving as much as they can, as early as they can.
Yes, very important now. And the earlier they can start saving, the less money they're actually going to have to save because of the compounding effect. And the later in life that you start saving means that you're going to have to save a larger percent because you're going to have less compounding on your earnings.
Where do ETFs play in this? We hear a lot about ETFs.
ETFs, to me, are the greatest investment vehicle that's ever been developed. And they're fairly new out there, but as of the end of this year, they have had such a huge success with individual investors and institutional investors. They have grown from almost nothing over the last 6 years to almost $1 trillion. And the reason for that is ETFs, number one, have the lowest cost investment options. And in fact, with our 401k plans, we'll have an average cost with ETFs of about 20 basis points compared with 100 to 125 is what you see in the average retirement plan. So not only are they less on the investment fees, but they also have less trading cost. Most individual investors do not realize that their mutual funds have large internal trading costs that also reduce their returns, where with an ETF has no internal trading cost. But even more important, with an ETF, an investor that we put in an ETF in a 401k plan, if they just stay and hold the ETF and never sell, they never pay a trading commission. But say like Maribel, if you're in a 401k plan and you tried to be a good participant and hold your investments when we had the downturn in the market, you were still paying the trading cost of all the shareholders that were bailing out when the market was going down, because the managers of these funds were constantly having to sell to raise cash. And then we had the opposite effect happen when the market went back up. So many shareholders were wanting to go back into the mutual funds because the market was going up, forcing the managers to buy in a market that was moving up and increasing the trading cost as well. So you, as a good participant that just stayed in your mutual fund, paid the trading costs for all the movement that was going out and in. Whereas an ETF, you would never have paid a trading cost.